Welcome to the chapter on working capital management. This chapter is crucial for understanding how to manage a company's short-term assets and liabilities to ensure efficient operation and financial stability. In this chapter, we will cover cash management, inventory management, and receivables management. Cash management involves the collection, handling, and usage of cash. It is essential for maintaining liquidity, ensuring that the company can meet its short-term obligations, and optimizing the use of cash to enhance profitability. Key concepts in cash management include cash flow, which is the movement of money in and out of the business, a cash budget, which is a forecast of cash inflows and outflows over a specific period, and liquidity, which is the ability of a company to meet its short-term obligations. Consider a retail company that needs to manage its daily cash transactions. The company prepares a cash budget to forecast its cash inflows from sales and cash outflows for expenses such as rent, salaries, and inventory purchases. By doing so, the company ensures it has enough cash on hand to meet its obligations and avoid any liquidity issues. Inventory management involves the supervision of non-capitalized assets and stock items. It ensures that the right amount of inventory is available at the right time to meet customer demand while minimizing holding costs. Key concepts in inventory management include economic order quantity, or EOQ, which is the optimal order quantity that minimizes the total inventory costs. Just-in-time, or JIT, which is an inventory management strategy that aims to reduce inventory holding costs by receiving goods only as they are needed. And safety stock, which is extra inventory held to guard against uncertainty in demand or supply. The economic order quantity, or EOQ, is calculated using the formula EOQ equals the square root of 2 times the annual demand times the ordering cost per order divided by the holding cost per unit per year. Here, D is the annual demand, S is the ordering cost per order, and H is the holding cost per unit per year. For example, a manufacturing company uses the EOQ model to determine the optimal order quantity for raw materials. Suppose the annual demand is 10,000 units, the ordering cost is $50 per order, and the holding cost is $2 per unit per year. The EOQ is calculated as the square root of 2 times 10,000 times 50 divided by 2, which is approximately 707 units. By ordering 707 units each time, the company minimizes its total inventory costs. Receivables management involves managing the credit extended to customers and ensuring timely collection of payments. Effective receivables management helps in maintaining cash flow and reducing the risk of bad debts. Key concepts in receivables management include credit policy, which are the guidelines a company follows when extending credit to customers. An aging schedule, which is a report that categorizes accounts receivable based on the length of time an invoice has been outstanding. And collection period, which is the average number of days it takes to collect receivables. The collection period is calculated using the formula collection period equals accounts receivable divided by credit sales times 365. This formula helps in understanding the average number of days it takes to collect receivables. For example, a company has accounts receivable of $50,000 and annual credit sales of $600,000. The collection period is calculated as 50,000 divided by 600,000 times 365, which is approximately 30.42 days. This means it takes the company, on average, about 30 days to collect payments from its customers. Effective working capital management involves balancing the components of cash management, inventory management, and receivables management. By optimizing these areas, a company can ensure it has sufficient liquidity, minimize costs, and enhance profitability. Understanding these concepts is essential for first-year finance students as they form the foundation of sound financial management practices. Thank you for watching this chapter on working capital management. We hope you found it informative and helpful.